Jim, I'll let you take it away.
Susie, thank you. This morning we heard a lot of trends and great information about how well the golf industry is doing. We've all enjoyed it the last 3 years. We've all been wondered about runway. Obviously, it looks like we've got good opportunity for runway. So this panel is focused on transaction side. There's a lot of us, that are buying golf courses now or look to buy golf courses now. So we really want to understand, with all the things that are going on in the world, how's that going to affect us on our deals? We've got a really interesting panel here over there because Jordan with Baird, he's an investment banker and he's been on the buy or the sell side of several golf portfolio transactions in this room here, and also a lot of other hospitality, leisure related business. Weston is with Apollo. Apollo is one of the largest private equity firms in the world. In 2017, they bought Club Corp, which is now Invited. So they have the experience of owning and operating, the most valuable company in the golf business. And then this young man here, Jeff, has sold us a lot of golf courses. He's very good at getting us to pay up, but we've got a good group here. So what we want to do is to frame this up. Instead of starting on the golf side, let's talk about what's happening in the world around us and how that'll affect golf. So, when we talk about, the big picture, we hear all the good things that are happening to us in golf right now, but when you look out there, there's a lot of uncertainty out there in the world. You've got the whole issues with the Fed, recession, interest rates. We've got elections coming up. We've got geopolitical issues with Ukraine and with China. And so I think what Weston's going to start off with from Apollo's viewpoint is, what do you see happening in the world, the big picture in the world? Talk a little bit about the hospitality and leisure sector, and then how do you think that can affect golf?
Yeah, thanks. So I'll start off. I'll say, thinking big picture, Apollo's view sort of on broader macroeconomic conditions, I think is important just sort of to take a step back of where we kind of came from, which is you take a step back and you look at what happened with Russia invading Ukraine. And I think that was sort of the tipping point for a lot of the dislocation that you're seeing in the market today. Prior to that, rates were low, financing availability was high, leverage was high, equity checks were quite low. I think, what we see is ever since that has happened, there was a lot of uncertainty, which just led to investor sort of protection, if you will. And I think how that has really affected our deals has been tremendous. I think thinking through refinancing, thinking through rates, how we finance deals, and this is all stuff I'll hit on a little bit more in the discussion. Everyone's taken an incredibly conservative view, and frankly, the availability of leverage has been quite low ever since then. So take a step back and say, okay, everybody understood what happened. Inflation was rampant. The Fed needed to slow that down. They hiked rates. We were at a position where LIBOR, SOFR was at 1%. We're at greater than 5% today. That's really taken a drain on companies and frankly, the availability to be able to fund growth. So, I would say really what that means for us though is we've been very cautious. It's affected valuation. And as we sort of sit here and we take a step of what does that mean looking forward? I think it's a couple things. One, we're incredibly cautious about the outlook right now. If you look at sort of consumer spending, you're starting to see slowdowns. We're probably at the end of what would be a historic rate hike cycle. You'll probably start to see relief from that with a final rate hike here in July. We think that's probably the final rate hike. And then we were thinking of an additional rate hike in September. We don't think that's going to happen anymore, so really what I'm getting at is everyone is becoming much, much more conservative about the outlook right now.
Mm-hmm. What are you seeing on the hospitality and leisure side with all the companies that you cover?
Yeah, it's interesting. So I would say overall, there's sort of two competing factors you have in this sort of market right now. Number one is you have private equity firms, all this pent up capital needs to be deployed. You've got strategics who generally have more cash than they ever had before. They need to be able to show growth to their public or private investors in some capacity. But then on the other side of that, you also have difficulty in getting financing, difficulty in getting sort of, good rates on that financing. But you also then have, I would say, a sort of high scarcity value of sort of high quality assets in the market. So you have these sort of different factors at play here where private equity firms want to deploy that capital, strategics want to deploy that capital, but they only want to deploy that for sort of A+ assets. And so, you put that all together and it just makes the deal sort of making sort of we're a little more difficult now. We have to kind of really earn our fees, Jeff and I do. But it's interesting because the assets that I would say are highly attractive are the ones we're seeing obviously the most interest in. The B minus, C plus assets, what have you. It's just harder to get sort of attention from buyers because they're picking their spots a lot more than they were before.
How do your caution versus what we heard in the last hour about the tremendous runway for golf? How, as an investor, do you look at that?
Yeah, it's an interesting question. I think as we think about caution, it's more we're starting to see slowdowns in consumer spending, and we have to think about what that does to valuation, what that does to sort of an outlook for if we're going to make an investment now. We're long-term investors. We think 3 to 5 years as a typical hold period. Some may consider that short-term. I consider it long-term. Really, what I think it means is, to Jordan's point, we're really just being very judicious, picking our spots. We want to pick A-plus assets. We're sort of risk off at the moment because of that. And I'm really talking broader leisure, not just golf and country club.
Are you raising capital now?
We are raising capital right now. We actually just did a final close on a new fund. And what I would tell you is the capital raising environment is quite tough at the moment. We are going to come out at about a flat fund relative to where we were previously. Mm-hmm. And that took a lot longer to raise than prior funds, just given that, one, there's a lot of interest in funds out there raising capital. And two, investors are being much more judicious as well about where they allocate that capital. Mm-hmm. And they want to focus more on value-oriented segments. They're turning risk off from some of those high-growth assets that you saw in some of the paranoia during the peak of the pandemic. Mm-hmm. And you're seeing that sort of play out in the fundraising environment right now as well.
So if you looked at the returns that you were promising or marketing a few years ago versus the returns that you're pushing out now, what's the difference?
The difference is we have to find better ways to invest the capital. So we're not promising any different returns in our funds. It's more us being very, very thoughtful about what is the downside protection. We're very focused on that at the moment. And then also, whenever we go through a due diligence process, really highlighting for ourselves, for our investment committee, where are those upside levers that we can hang our hat on, and what are we going to underwrite as a portion of those? And I want to talk a little bit more about that as we sort of delve into positioning a business for exit. But that's really where we're focused. We're being much more judicious, taking diligence much more seriously. And frankly, the lack of availability of leverage means that we're writing higher equity checks. Well, what does that mean? We need to show more growth to be able to get the same return.
The only thing I mentioned quickly, Jim, is on the hospitality sector in particular, the best thing about this sector is that for investors, it's very tangible, right? They're in airports. They're on airplanes, they're in hotels, they're trying to book tee times on their own, they're trying to join country clubs, they're seeing how busy things are. And so for them, they very much are focused on how do I become sort of a part of this? How do I benefit from all these tailwinds? And that gets back to sort of the scarcity of assets. It's really picking your spots around what are the ones that are most beneficial to all that.
Jordan, you and I were talking in the hallway, about the hospitality and leisure business and about the segmentation, the high end, the medium end, and the low end. Why don't you talk a little bit about what you're seeing with the sectors out there?
Yeah, absolutely. So, across my coverage, it's not just within golf, but it's also within luxury travel, high-end travel, villa management, what have you. I would say that you really have to sort of bifurcate sort of the world in sort of the high-end luxury versus kind of almost everything else at this point in time. And for those obviously who own sort of higher-end golf courses or manage higher-end facilities, what have you, there's no question you're seeing huge forward booking trends for tee times, the same way that places like the Four Seasons and Ritz and Peninsulas are for next December for Christmas break, what have you. And so, those sort of hospitality-like assets aren't seeing or impacted really at all in terms of what's happening right now in the economy. Obviously, everything else certainly is seeing that. And I'd say also from just an overall sort of, I always think about things in almost like a stepladder function for those families who otherwise would have gone on a budget trip to Europe this year, who can't afford to do so because it's too expensive or don't want to travel. They're not going to stay domestically and go to a local city or what have you, or drive somewhere instead, right? So, everyone sort of benefits in this, although candidly, the people at the very high end really are the ones who are seeing sort of the most resilience through all this.
Yeah, I think we're seeing that in some of our golf portfolios. The entry-level country clubs or maybe the lower-end public golf courses are starting to see some pricing sensitivity where, probably 30% of our portfolio is in resort markets, and we haven't found the pricing sensitivity high point yet on what we're driving on rates. So it's interesting. Let's we see those trends. Let's talk a little bit about transactions, what's happening. And I know, Jeff, your firm, covers all kinds of real estate. And I think when we look at transactions, before we get into golf-specific transactions, let's talk about what's happening in hotels, office, restaurant, other hospitality and leisure businesses. Are deals getting done? What's happening to the prices? Is leverage out there? What's happening to interest rates? And so how are deals being structured right now? Sure. Remember, you're not selling right now, okay?
Right. I'm not selling.
Okay.
Well, CBRE, we're the world's largest commercial real estate company. So we benefit from, I think we're Fortune 135 publicly traded.
Mm-hmm.
We benefit from a lot of research. And, this is the longest telegraphed recession in the history of the world. CBRE is saying it's going to be fourth quarter of 22, then they pushed out to second quarter 23, and now it's fourth quarter 24. And we were talking about it yesterday, and Morgan Stanley saying there might not be a recession. So I can tell you that the liquidity in the market for debt is just non-existent. And we were talking about it earlier at our table. It's what you guys are doing, is what I'm doing. I'm taking all my money and putting it in treasuries. And these small banks are completely out of the lending business, and it has cut back on transaction volume tremendously. I pulled some stats from CBRE, and they were pretty shocking from Q1 22 to Q1 23. So 1 year ago, the new stats for Q2 are coming out today, and I didn't have them at the time. So I apologize for that. And it's, from year to year, it could be 5, 10%, something like this. Overall transaction volume, this, Q1 to Q1 last year, is down 57%. Office is down 69%. Industrial down 44%. Retail, 51%. Multifamily, which is the safe haven for everything, is for all commercial real estate investments, 64%. Hotels is down 50%. And hotels is, it was a big year the year before, and so I'm kind of shocked that it was only 50%. Debt, the big elephant in the room is office buildings, as everybody knows, and that's what is the big concern. That there's they anticipate $125 billion in commercial real estate losses in the next several years, of which $53 billion is office. The offices, they're all going to be rolling over their debt as they do every 3 to 5 years. What they financed last time, they were financing at 3.5%. Now they're financing at 6.5%. They were financing at 100% occupancy or 95% occupancy, and now they're at 30 to 50%. So the office segment is a segment of the commercial real estate industry that is going to have a profound impact on just commercial real estate in general. However, with that said, our company thinks that it's still not going to put us into a tailspin or recession, even as dramatic as we're going to start seeing properties get handed back to the bank and real distress in the market.
But isn't that really just going to be a change of ownership? Because I assume you and some of your other competitors out there are raising funds, basically say, we're going to buy these things for 50 cents on the dollar.
That's certainly a portion of it. One thing that sort of Jeff hit on is, these folks went out, they financed their deals a few years ago, rates were low. What we have seen, and this is sort of broader, non-industry specific, but what we've seen in the capital markets is a real shift towards lenders being more proactive, working with companies to go ahead and proactively extend their existing debt tranches, because the refinancing markets, frankly, are not there.
Right.
So what we've really seen is really proactive dialogue with lenders, a bump in rate, an extension in tenor, in exchange for, hey, everybody kind of knows the financing markets are in a little bit of a dislocation at this point in time. Everybody knows that they're going to ultimately be able to refinance down the road because, frankly, I think it's our view that there's a little bit of a soft landing recession. So everybody's sort of kicking the can down the road right now. We are actively looking at a handful of really attractive opportunities, more in sort of the distress for control scenario. And mostly what drives that is a lack of liquidity at the company.
Okay. When you talk about the refinancing, you've got a lot of stuff maturing, and a lot of golf course buyers are usually trying to go to the regional banks in the local market to get it. And you're going to explain this much better than me, but with what happened with Silicon Valley Bank, you saw a lot of flight of deposits from small regional banks up to the larger mega banks, and that changed the capital core ratio. Can you explain to everybody how that works and how their lending capacity shrunk because of the flight of deposits?
It is true. I think the lending capacity certainly shrank. I think what would be helpful is if I could point to some specific stats for you. So if I recognize that this is not specific to the golf industry, but broader deal making. We used to finance our deals with 6 times leverage, and that's a multiple off of EBITDA. That's very simple, debt to EBITDA. 6 times leverage was what we typically would finance at. Deals are now getting done at low 4s leverage, significantly lower. What does that really mean, though? The valuations really haven't come down all that much. So what that really means is that the equity checks are getting much higher. Mm-hmm. We used to typically finance at 30 to 40% equity. Now we're at 50% plus, and frankly, lenders are demanding that you're at 60% plus. So that's really sort of the end result of some of those dynamics of that shift in the banking issues.
The other thing in addition to that is without having access to some of the commercial banks that are more sort of pure play names people would know regionally, and the business is maybe too small to be, working with sort of a JP Morgan or a larger bank, right? They have to go to these sort of private debt funds. And those sort of private debt funds typically are going to charge more because they're more of like a private equity fund, but they're just not equity focused, they're more debt focused. And so as such, there's a higher cost of capital there as well. So there may be lending available for some of these smaller assets that can't access sort of the bigger private banks, if you will. But the problem is it's just a higher cost of capital.
Yeah, and frankly, if I could add on to that's a big trend that we've seen in the financing markets over the past 5 years. The direct lenders, they've been raising money hand over fist.
Right.
They are active lenders, and frankly, I think they're taking over a lot of what used to be bank lending, just given some of the additional scrutiny, some of the regulations that have been placed on the banks.
How's their pricing different versus from a JP Morgan or a Wells Fargo?
Yeah, I mean, a lot of those groups are going to look for, well into the double digits of interest rates, 12 to 14%, sometimes even more than that, right? And it may also be sort of a quasi-structured deal where they may say, if things don't go well, you can't service things. We're going to begin to claw back equity, take equity, or maybe you're going to pay us what they call PIK, pay in kind, where they actually give us equity as we sort of, move on as your lenders. And so I think that's the other thing you're seeing is it's not just a straight L plus 300 at 6 times leverage. It's going to be, as we say in banking, a little hairier than that in terms of having some complexity to it.
And it's not relationship based, whereas before it was banking, it was relationship based, it was very transactional. Mm-hmm. These folks they're pure investors. Yeah. So they've got more restrictions on what you can do, where you can use your capital. And frankly, they've got more restrictions in terms of covenants that, hey, if you pass this level, it's a technical default, and we've either got to negotiate an amendment fee, or even if the situation gets more dire, they'll take over the business.
We have a very robust debt and equity group out of New York, and when we took the Pac Life portfolio to market, they were saying, please, let us take it out, let's see what the debt market is. We're very excited about doing this. So they did, and they came back. The best they could get was 12.5%, 50% LTV. And that was the best that they could find out there from these lenders, these direct lenders you're talking about. Not the life companies.
The hot money.
And that used to be 30 to 35% LTV.
Okay. Yep.
But I think what it also means, though, for people in this room, though, it also is a function of making sure that, one of the things that private owners like to be able to do is sort of spend money the way they want to spend money, right? Whether it's buying other businesses, other courses, investing in CapEx, what have you. Some of these sort of other lending institutions are going to become a lot more restrictive around what that means. And every free dollar you generate has to go down to pay down them first or pay down debt versus being able to go out and acquire a new course nearby or, deploy CapEx.
So if we look at the hospitality and the commercial real estate transactions, is pricing come down? Because in theory, you would say it would come down. Have they come down?
Yes. I mean, across commercial real estate, I'm not in that world every day. I just get the reports, but yeah, the cap rates have definitely, they've definitely gone up on every single. I mean, you're looking at, I see offerings for multifamily, and they're going up. A lot of these buyers out there are raising their money with limited partners, and we're seeing the prefs for those go from 8% to 10% prefs for raising equity. So they're.
How much are the cap rates moving?
Oh, it depends on the product type. Right. I mean, multifamily, not a whole lot, but I mean, you're still seeing some transactions where there's a negative arbitrage. They can't get debt at 6.5, but they're buying the property at 5, but they think they can get to 6.5, 7 once they do the efficiencies. And I think that's the trick right now is trying to not be in a negative leverage position and just only count on the equity because it's cash flow and it's growth in equity that people buy commercial real estate for.
Got it. So from Apollo's standpoint, what's your view on interest rates and what's going to happen?
Interest rates will start to go back down. If you had asked me this question a month or two ago, we were pretty hawkish that there was going to be another hike in July and potentially another one in September. I think it's broad consensus that they'll hike 25 basis points in July, hold in September, and see how inflation's doing. It's obviously started to come down from, call it like 8-9%. The last print was 4.25%. That's going to get, the consensus is that inflation gets more towards a normalized level of, call it long-term 2 to 3.5%. Back half of this year, early next year, I think that's when you start to see rates come back down.
And where do you think they normalize at?
That's a good question. We've seen low rates for such a long time. That's a good question.
You look
I
at
don't think we're going back to the 1% LIBOR.
you look at
rates.
the forward curves, and it all kind of says 3.25% for SOFR.
We're not going back to the 1% LIBOR.
Okay,
rates. Yeah,
that's done.
that's done.
Okay. Hey, before we get into the golf side of it, are there any questions from the group out here about the big picture, about what's happening macro, with hospitality, leisure, commercial? Okay, great. So let's get into what's, from your viewpoint, what are you seeing right now in the environment that we're in? Because we've got these tremendous success for the last 3 years. You look like you've got a runway that looks good, but on commercial side, looks awful out there. So what are you seeing happening in golf transactions now?
Well, there was a new study that was released recently that the COVID virus was not formulated in a lab in Wuhan. It was actually formulated by the PGA. And pretty sure that was on Susie's watch.
Okay.
So I was excited. I was excited to hear NGF's runway, because that's been, as we've been going along, it's, everybody's saying, how long is this going to last? Yeah, but wait until the next recession. And we've all been in this business, the old timers been in this business 30 years, and we see what happens in the recession. And golf is something that gets cut out of the diet pretty quick.
Mm-hmm.
And I think from past recessions, and based on the buying criteria of a lot of buyers in this room, they're liking the high-end private, as we talked about. That's going to be affected the least. So we're seeing that when we have private clubs, the buyer pool is deeper. Mm-hmm. Versus daily fee. The Pac Life portfolio was one of the best portfolios we ever had the opportunity to work on. Fantastic properties, irreplaceable. But the buyer pool was more shallow than if those were all private clubs.
Mm-hmm.
Yeah, I'd say overall, what's interesting is you look back over, since maybe the early 2010, 2012 timeframe, the sort of transactions that occur in this space tend to happen in kind of waves, right? Mm-hmm. Back in 2014 to 16, we advised on the Sequoia Golf transaction. There was a C&L assets, true and traded for the first time. There was a bit of a lull. Over the last 3 to 4 years, you've seen a whole litany of deals get done, where we now have probably a half a dozen or more, private equity-backed, well-capitalized, sort of sizable portfolios out there. And all these private equity firms, to our point earlier, have all this capital that needs to be deployed. No one, including like Apollo, wants to just deploy an equity check and just let it sit there. They always are looking to deploy more strategic and synergistic capital. So I think over the next 3 to 4 years here, you're going to see a lot of that, where you also have a lot of parties that candidly are runner-up in processes like Pac Life or Concert Golf or True and other names like that, who got their investing committee all excited about the sector, who are golfers themselves, who are trying to join country clubs in Cannes, who have kids who are trying to get tee times at public courses in Cannes, and they want to be a part of this, right? So you've got well-backed, capitalized, private equity-backed, strategics, but you also now have all these other groups who weren't able to prevail in those processes, and they're looking for assets. The last thing I'd say as well, on the real estate side, is we're also seeing a lot of the real estate players who, historically were investing in commercial real estate, who don't want to touch it, right? And they're looking for other types of real estate where there's really good tailwinds, i.e. golf. And so you now have these different sort of disparate buyer buckets who are all very interested, again, in high quality assets.
What are you guys seeing on the resort side?
I'm sorry?
On the resort side.
Yeah, so again,
golf resorts.
Yeah, it's interesting. I would say, again, that's an element where the buyer universe for I would say groups who can invest in sort of asset heavy businesses with CapEx intensity is pretty limited. Mm-hmm. As you begin to kind of narrow that group or filter it down based upon, owning a lot of land, owning hotel, owning F&B, owning the golf course operations themselves, you become even more limited, right? So you have a very high caliber group of buyers, i.e. like an Apollo out there or a Blackstone or names like that. but it's a very high quality, but probably a low quantity depth of buyers, candidly. But that all being said, what's interesting is that, as I always think about this sort of world, there's kind of two elements of sort of valuation. One is what I'll call the tangible, i.e. the EBITDA, the cash flow, and applying multiple to that. There's also the intangible, right? How do you recreate a Black Hawk or pick a name, whatever it may be, and you can't, or a stream song. And so you basically have this sort of what is a rational, multiple to pay based upon cash flow, but it's also, well, how can I recreate this business? And I can't, so I got to pay a premium based upon that of an extra turn, 2 or 3 of EBITDA, basically.
The leisure market is the fundamentals are really strong right now.
Mm-hmm.
I fall under the umbrella of CBRE Hotels, so I'm on a call every week with them, and they're all saying that the BOVs are starting to ramp up.
Mm-hmm.
So it's the business travel that hasn't quite come back.
BOV.
Broker opinion of values,
Yeah.
where these owners of these resorts and hotels are starting to consider, when the market does turn, because the fundamentals are really strong right now for leisure travel, and it's just really business travel hasn't quite come back to where it was pre-COVID, but leisure is where it was pre-COVID, and it's strong.
One thing that Jordan hit on was just the availability of capital right now. And you look at sort of all the capital that's chasing after these deals. I think whenever you take a step back and you look at macro valuation multiples, we really have not seen any relief or reversion in those multiples. And I think it's really a result of there's a ton of money chasing after these deals that keep the valuation inflated. Mm-hmm. And the other point that I think Jordan made that was really interesting is whenever you look at to invest in a golf asset or a similar business, there's an opportunity to have a second bite at the apple to continue to deploy money, whether that's investing it organically in the business or maybe it's inorganic growth through consolidation of the industry. That's a great opportunity. Folks get their investment committees comfortable with that. Maybe they're not the prevailing buyer, but they know there's opportunity out there, and that continues to push up the valuation multiples.
We're seeing, in every offering that we have, there's always 2 or 3 high net worth individuals popping up because they've been chasing multifamily, they've been chasing, other properties. In fact, the Grove, which we just got done marketing, the runner-up was a guy who owned 2 substantial multifamily units in Nashville. And he's thinking, gosh, I'm not getting the same multiple. What's wrong with 10 times? There's nothing wrong with 10 times.
Yeah.
I also think
because he's not getting that on any other investment he's got.
Yeah. It's interesting because I think for a long time, just to speak very candidly, I think golf was sort of kind of a bad 4-letter word to use in transactions overall. Yeah. Back in 2014, when we sold Sequoia Golf, for instance, I tried to get through my pitch to different investors as long as I could without using the word golf. Let me tell you about this great asset with tremendous visibility, recurring revenue, underlying real estate, huge demand, great management team, inorganic growth. Oh, and by the way, yes, it's in the golf space, and you maybe get a hang up or what have you. Now that's totally different now. I think because of the experiences that people are seeing firsthand, again, the tangible nature of golf, they're going to these different resorts, they're trying to book tee times at Pebble Beach or Bandon Dunes, and they can't. It's not such a bad thing anymore, honestly.
Yeah, well, we've been having this meeting, I think, in this hotel for 25 years. And so we've been through up and down cycles, and we always had a financing panel. And for probably 10, 15 years, Ray Munoz, who ran the lending platform at Textron, he'd basically get up and go, you're screwed, okay? Golf's red line, it's a bad word. And so you've got to find a local lender, a mom and pop lender who likes you, or do SBA. That's how to go.
It's interesting because whenever we talk about financing on the invited side,
yeah.
The feedback that we get are twofold from lenders. They like the downside protection that's afforded to them with the real estate, and they like the stability that has the recurring dues in the businesses. And frankly, I think like a recurring theme that we're all hearing here is they prefer to be in the high end of the market as well.
When you look at golf transactions out there, you've got the super high end deals, expensive deals. You've got, I'd call it medium to high end. You got the low end stuff. So you probably don't play in the low end stuff at all.
Not a lot. No.
Okay. And when you get to the medium, upper medium, and the high end, where I think most everybody in this room plays in right now, are you seeing, when you're working on your deals, are you seeing individual mom and pops that want to buy a golf course, or is it mainly institutional investors or institutional wannabe investors? No,
we call him Joe Blow, the head pro, and his buddies that have a lot of money, and they'll chase those deals. And the reason we don't play in that space, where Hilda was so prolific at, is that they're harder to do. They're less, the buyers are less sophisticated, and that is quite frankly the issue, with the high net worth individuals. They got money, but
Mhm.
they're not very sophisticated. It's a lot of hand holding, and they got to understand. They don't understand the initiation deposits and stuff like this. But they are truly a group of buyers out there that will really look at anything because they like those returns.
So what about private versus public? Because on the private side, everybody loves the stability of dues. On the public side, it's different. Because you got the volatility of the weather and the non-recurring income. And you look at most of the private equity platforms, they've migrated towards private. So where's the public market out there?
Well, I mean, it's like what we were talking about with the replacement cost. I mean, Greyhawk, phenomenal facility. Thank you, Blake, for taking down that portfolio. And it was a big number for Greyhawk. But if you had to go buy that land and in Scottsdale and build those 2 golf courses and that clubhouse and Isabella's kitchen, you couldn't do it for that price. It's not. You can't even come close.
Nobody buys that argument though about replacement costs on golf.
I think
it is. We've been hearing that crap for years. Okay,
but
yeah,
it's got to be built in conjunction with residential. It has to.
Yeah. So, but it's how much money does it make? So
Yeah.
So, do you think are institutional investors looking at public golf?
I think less so unless it's a very sort of high caliber property, right? I mean, again, using sort of extreme examples like the Pebble Beach or names like that, right? To where, yes, it's public and accessible, but obviously the sort of cachet around that, the brand caliber, what have you, is very, very high, right? So I'd also say that, to that end, not all public golf courses are sort of created equal, right? And there's different sort of valuation drivers as to what, where is it in the country? Is it year round? Are there high water costs? All these sort of things. Like what institutional investors are really looking for, which is very simple, is sort of a high level of recurring revenue and a high level of visibility. And so that's why software businesses that trade on the revenue multiple are, so highly valued, right? It's because there's huge visibility and there's a huge amount of recurring revenue, as opposed to a local muni or public golf course, which is what I call sort of hand-to-hand combat. Every day you got to fill a tee sheet up, right? And so the best thing about private country clubs is that they obviously provide that sort of recurring revenue and revenue visibility. The other thing I'd say is that, most larger private equity firms have an operational team who like to come in and optimize things, whether it's pricing, CapEx spend, what have you. And so the best thing about sort of golf courses, generally speaking, is they're almost like their own little mini economy, right? Especially the private ones. You've got initiation fees, you've got monthly dues, you can optimize sort of expenses, what have you. And so the ability to kind of come in and do that is pretty unique for these larger private equity groups.
The one point that I would make on the public courses, and this sort of goes to how we think about creating value in a business, is if you take the public course and you start to think about, well, what could this be? And then I think you start to think about, maybe you get it at a discounted valuation. It becomes more of a growth play rather than the recurring, stable growth, stability play that Jordan was mentioning, which is obviously more attractive. I think that's where you find more interest in the public courses.
Okay.
But I think, you talk about the replacement cost thing, and you said for years we've been talking about that, but it has never been more expensive to build.
Right.
Water has never been under scrutiny like it is right now. The barriers to entry to build a golf course right now are the highest they've ever been. So I think that benefit, and what we heard from Greg this morning, that benefits both private and daily fee.
I'll get there. Weston, why'd you guys buy Invited?
For all the things we just mentioned, it's a core tenet of the thesis was, as we think about investing, we always are very focused on downside protection. It's the built-in real estate value that you have there, the replacement value. And then frankly, you just look at the core stability, the recessionary resistance that we saw in Invited or Club Corp as we sort of peeled back diligence. And then frankly, it was the opportunity to optimize and grow, whether it's through initiation fees, whether it's up tiering into the higher end of the market and increasing dues. So frankly, it was a little bit of an odd underwrite because it was mostly focused on the downside protection and you kind of know where your upside's going to be, but we pay a premium for that stability.
And when you're underwriting it, or a lot of times golf's considered commercial real estate, income producing real estate. So you can look at it as a cap rate if you want to, or the cash flow yield, or you can look at it as maybe it's Invited, it's a membership subscription business. So what category did you put Invited into?
Membership subscription, completely. The real estate was purely more asset for lenders. And as we think about sort of comps and who we comp against, and frankly, talking to other investors, to lenders, et cetera, they always look at membership-based businesses. It's Lifetime Fitness, it's Vail, it's Soho House, it's businesses like that have sort of that built-in membership base and the recurring nature, and that's always who we comp against, never the real estate folks.
When you're talking to investors, someone that wants to buy a golf course and you sell it, what's your underwriting pitch as far as how to value this?
Well, it's every situation is unique, and it depends on obviously the initiation deposits is something that is always under scrutiny, whether it's the 30-year variety or the ones that just went in, one out. That's a huge component of it. I mean, the Grove in Nashville has mandatory sports memberships, and with a very large and still growing community. So there's different, as you want to try to look at the courses that really have the most attraction is the stickiness of the membership and the stickiness of the business, going forward, whether it is F&B or it's the sports membership or it's or the golf.
What kind of returns are you trying to pro forma for the buyers to get?
Well, obviously the guys like your investors and the bigger investors, they want more than they want a return on their investment more than 10. I mean, they're trying to get there. I mean, that if they got to go in at that number, they're going to pro forma something that's going to be larger than a return on that, and really bring the multiple down as far as their net income multiplier, as we say, or the inverted of a cap rate. So every single buyer is looking for some sort of upside. They're not just buying the cash flow. If it was just the cash flow play, it'd be, that's why multifamily is so stable. And that's why that's so easy. Where golf, you guys are not just looking for, a 9 or a 10 times. You're going to be looking at something like, well, when we did the X, Y, and Z, and we grew the top line, then we were able to get to more like a 7 or a 6 times.
Yeah, I've probably been involved over the years in 400 buy-side transactions, and never once in all those transactions have we ever bought a golf course that's stable. Right. It's in good shape. Every one of them has been a turnaround, and that's how you have to model it.
Right.
Jordan, you've been very creative and very successful in painting a story for some of the golf portfolios that you've marketed and got incredible pricing. How do you do that?
Well, first, there's a lot of factors I would say that are involved. It depends on kind of what you're selling and who you're selling it to. But I would say that there's a couple of key things. Number one is sort of the underlying sort of growth plan, whether it's organic or inorganic, right? The second is sort of a management team. If you're trying to sell a platform to a new private equity sponsor, they need to be able to understand that the team that they're investing in is a team that they can back, which is really important. I'd say also the idea of just having an overall sort of easy thesis around what is this business actually trying to do over time. A lot of times we get approached by companies, not just in the golf space, but otherwise, who come to me with 29 different growth initiatives. And we'll execute upon all these over the next 5 years. And I think the idea of having a very simple story around 1 or 2 or 3 things that investors like Weston and his team get their arm around, because ultimately what it comes down to is, private equity groups and strategic buyers have to be able to summarize all this into some package, right? What am I going to do with this? And making sure it's very streamlined with a team you can back who has a real sort of thesis on what they're trying to create. That to me is what sort of makes a great sort of outcome, honestly. I'd also say that, to the extent that you're sort of, selling an A+ asset, it makes things a hell of a lot easier than if you're selling a C- asset, right? I mean, just generally speaking, it's just easier to tell a story. And I'd say that, in all of our processes, more recently, we worked with Concert Golf with their transaction with Clear Lake, and we sort of far exceeded expectations in terms of just the number of bids, the number of parties who were interested, valuation, all these sort of things. And I think, we sort of did that in a way because the way we ran our process was to really be very hands-on. Getting back to my earlier statement around sort of golf historically being kind of a bad four-letter word. If you or if anybody, Jeff and I, were to have you just put together a presentation and just put it on 100 of our closest friends' desks and say, give us a bid a month from now, what's going to happen? You're going to get really small uptake, if you will. You've really got, in this sort of market in particular, got to go out and tell the story and do a lot of the sort of picking up the phone and calling people. It can't just be a 2-word email or 2-line email saying, hey, I'm selling this golf portfolio. What do you think? Give us a bid a month from now. You got to really walk them through the differentiation around it.
So what he's really saying are investors are very ADHD, so you've got to serve it up on a silver platter.
How about family office?
Yeah. Yeah.
What's the interest in golf from family offices?
Yeah. So the interesting thing about family office, and you mentioned this earlier, Jeff, around sort of the high net worth individuals, is those two things really go hand in hand, right? I mean, family offices by nature tend to be high net worth individuals. And so what they're looking for is sort of trophy properties. They themselves are members at probably more than one golf course. And so the idea of them sort of owning assets that are sort of marquee assets where they can walk up with their friends and say, oh yeah, by the way, I own this. There's an element of that they really are attracted to. And we're seeing that across other areas. I mean, we've done a lot of work in the luxury cruise business and, with luxury hotels, what have you, and the same sort of thing exists, right? To where people are like to be associated with sort of high-end brands to the extent they can be.
And we're seeing the family offices also become some of the greatest sellers because the dad was involved in it and then the kids just give me the money. I just want the money. So we're seeing them be sellers as well. So they're both sides.
When I left Club Corp and started Century, so in 2004, started raising capital and ended up raising $180 million in debt and equity from GE, Lehman, and Walton. And the investment thesis was, hey, we had a good management team because we ran Club Corp, but more importantly, that there were 5 different private equity firms that had invested in golf, and their fund timing was coming up. Okay, and so between 2004 and 2008, there were going to be 700 golf courses come to market, which did happen. And they were cheaper by the dozen. So that was my investment thesis. And people said, yeah, there's product out there. They liked the yields because the cap rates on golf there's probably a 350 basis point difference between commercial real estate. So they loved that there was deal flow out there. They loved that there was margin, and good cash flow. They were scared to death about exit, okay? Because their first question was, how much is it and how am I going to exit? And so for so many years, that was a problem. Well, that's totally flipped right now, okay? Because we have, sitting in this room here, we have a half a dozen private equity firms that have backed golf platforms. And they're all in various cycles, but you could argue that in the next 5 years, virtually every one of those platforms could transact. And that would be, by my math, you guys are probably hope it's higher, it's over $7 billion in golf courses that could transact, or platforms or portfolios in the next 5 years. So how do you guys underwrite an exit when looking at this environment today?
Yeah, it's challenging. I mean, frankly, if I could take a step back, even not talking golf course, exits are getting more and more challenging. I think investors are demanding higher quality assets, frankly, a little bit more meat left on the bone because they've got a higher return threshold to clear because their equity checks are going up. As it's become what used to be 5 years ago, not much of a focus, to now, which is in every single memo that we put in front of our investment committee, how are we going to exit? Is it going to be a private sale? Are we going to split it up? Is it going to be an IPO? Obviously, that's only relevant for certain sizes. But we really think about it. We look at the buyer universe. We start to map out who are the logical buyers. How are we going to ultimately position the business? And then we develop a plan from purchase to exit. This is what it looks like today. This is what it looks like in the future. And this is what we think is going to make it the most attractive platform for the next buyer. And this is how they're going to show growth to their next investment committee. So it's really more about thinking ahead, planning ahead, starting to map out where that meat's still going to be left on the bone whenever you exit and how you're going to ultimately package that in a nice, simple story for the next buyer.
So that was great in theory, okay? So, but with Invited, what are you going to do?
What are we going to do? You're putting me on the spot.
And if you don't want to answer, you don't answer. Yeah.
Wes, you should hand out 80 NDAs is what you should do. Then you can say whatever you want.
Here's what I will say.
Yeah.
The IPO markets, this is obviously specific to Invited. The IPO markets are a bit choppy right now. They have been ever since the Ukraine invasion. What I would say is whenever we do ultimately exit, what we've really done over the past, call it year, is really focus on simplifying and transforming the story. Whenever we spoke with investors, call it a year or 2 years ago, it was, hey, let's talk a little bit about our golf and country club segment. Let's talk a little bit about this Big Shots, which is more experiential golf. Let's talk a little bit about our city stadium clubs. The feedback that we got from investors at that point in time is, where's your focus? You're spending half the meeting talking about 10% of your EBITDA.
Yeah.
They wanted a very clear, focused, streamlined story. And we've taken that feedback, we've packaged it, we've focused on our golf and country club segment and how we're going to grow that. And ultimately, how do I think we're going to exit? It's going to be some process, likely an IPO with a dual process to create tension.
I also say, what's interesting we're seeing with private equity groups is a lot of them are now creating funds which have a longer hold period or don't need to return capital.
Right.
So we've done a number of transactions where a private equity firm invested at year 4 or 5. They say, listen, we love this business. We love this asset. We've spent a lot of time in it. Yeah, we could probably sell it right now for a decent price, but there's a lot more we can still do with it. We're actually going to shift it from Fund 3 to Fund 4. That's happening. There's also a new product that's been around for a little while. It's become sort of more commonplace now as a continuation vehicle. To where a lot of times you have private equity firms who will work with their LPs, who are the investors in those funds, and say, listen, we'll kind of take this out of the hands of a fund. We'll give liquidity. We'll put a mark on the board. But now we're going to hold it ad infinitum in a different sort of longer term hold period. And I think a lot of times when we work with private companies, the biggest sort of pushback we get with founder owners is that I'm really concerned about being sold to a private equity firm that, 5 years from now is to sell this business and put points on the board. And my issue is that right now, for the longest time, I've been a founder-owned business. I've done what I wanted when I wanted. I do want to get some liquidity. But I'm going to sell my business to somebody. I'm going to roll over 20 or 30% equity. They're now going to be in control. I'm going to do kind of what they want me to do over the next 3 years. And at year 3, I got to stop doing what I want to do and begin to position this business for an exit at year 5.
Yeah.
And that actually limits a lot of companies from sort of executing upon their growth initiatives. And so a lot of these new funds are saying, listen, don't worry about the hold period. We can hold you for 10 years, 12 years, what have you. Well, that's also what's appealing about a family office or high net worth individual who may never sell the business. And a lot of founders really appreciate it as well.
Obviously Invited is big enough, to be a public company. And Jordan, you've been on several transactions, let's call it, in the hundreds of millions, not billions. How much room is there in the marketplace for more than one public company in the golf sector?
Yeah, I don't know.
That is a good question.
Yeah, I mean, I don't know why there wouldn't be availability and capital out there for institutional investors to invest there. I would say overall, what's interesting is that in the broader travel and leisure space, this very big picture here, there aren't more than a dozen private companies out there. I mean, you have groups like Expedia and Booking and TripAdvisor, names like that everyone knows about that's public, right? Mm-hmm. But beyond that, there are not a lot of publicly traded comps. And I think that being said, that you have a lot of these institutional investors and private equity investors who want to invest in experiential businesses. They're not investing in Bed Bath & Beyond anymore, as we all know. And so they have to kind of take their sort of a consumer experience and their knowledge of how to basically drive customers and drive conversion and customer acquisition, but take that somewhere else. Topgolf, before it got acquired by Callaway, that would have been a phenomenal sort of public story. Obviously, people would have loved that. Mm-hmm. The other thing I mentioned is that what we're seeing in sort of the travel and leisure sector, getting back to my tangible comment, is that, for people who can go to an invited golf course or who are a member of an invited golf course or, can actually go and attend certain things, their view is they see how popular it is. And they say, wow, if I could invest in this business. Well, sure enough, when businesses like that become public, there's also a very strong sort of retail element as well that exists, which obviously benefits the public company.
What are your thoughts on that as far as public companies?
We saw the REITs that came and went. I think it's the continued growth that Wall Street demands. The dividends and the earnings that I think sometimes it could be difficult with golf, with the ups and downs. But we're in this. I said this morning that this new era of golf and in prosperity and what people want to spend their money doing. So, maybe it's a new thing where you can actually go public and you can every quarter you can generate earnings that makes Wall Street happy, because it's all about the growth of the stock.
When you talk about the REITs, obviously American Golf and NGP were the biggest. And really, they struggle because of a structural issue, okay? Because, you was NGP, the REIT was a public company, and then the tenant was private, and the tenant owned 100% of the tenant, and he owned 50% of the REIT. So there's a huge structural conflict issue there. The hotels have got around that with the TSR, taxable REIT subsidiary. Do you still think that golf could be a REIT?
I do.
Mm-hmm.
I think so. I think Invited's doing that with some of their acquisitions with the sale leasebacks, that kind of model. That's been a successful model already. I think that if it's taken on the public level, I think it can be.
Mm-hmm.
Go
No, go ahead.
I was going to say, one of the other things we're seeing as well is in sort of processes that we've been running, we've been looking to sort of optimize the valuation for the seller. And that may mean selling the whole business, sort of the opco and propco, if you will,
Right.
to one holder. But it also may mean running sort of processes to both propco and opco potential investors, right? Propco being more real estate focused, opco being more asset light focused. And, does 1 + 1 equal even, 2.1 versus just 2? Is it worth it with the complexity to try to do two different transactions? What we've seen historically is it's been difficult to kind of find the right mix of sort of a real estate, investor and also sort of an opco buyer and maximize the valuation. And also, like I said, it's the complexity of getting a deal done in that sense. But, that's the other option you're seeing as well now.
And part of the issue with that is the opco leverage that you can get is not where it once was, which makes that trade a little less attractive for someone like Invited today.
Okay. Obviously, private equity has been in the golf business for quite a while. It's really scaled up in the last few years, and it's provided capital for a lot of successful people in here to be able to scale their business. And so if you're sitting in this room and you've got a smaller company and you'd like to look at scaling it up, how do you position your business to have a conversation with you guys about, investing in private equity or having a family office? How do you go about that process?
Yeah.
Besides hiring you, go ahead.
I was thinking that you said it, not me. I'd say one of the most important things that I think is really sort of underrated but very important is sort of this general data reporting, financials, what have you. The number of times we come across companies that are of good scale that manage a number of courses, or it may just be in the broader travel and leisure sector, where there just isn't sort of good internal reporting. And you say, well, how much money are you making every year? Well, it could be 8, it could be 18, I don't know, somewhere in between. The ability to have sort of really strong internal reporting so that you actually can sit down and have a real discussion. And what does that mean? And thinking about sort of the financials of the business, who is going to actually be interested in the business, who would you actually go to in a process? And I think also, thinking through what your objectives are, right? Are you somebody who has a management team around you that wants to, as we say, kind of roll for the next buyer and roll a bunch of equity and continue to grow the business? Are you looking to quote unquote sell out to a strategic? Are you looking to sort of be a part of private equity sort of system where every 5 years you're being sold? It's understanding kind of those different options, thinking through those. And that way it also allows, advisors like Jeff and myself to think through what kind of process do we want to run? Who are we going to approach with that? What are the objectives you want to have? But I think it also all starts kind of with the sort of core around, a lot of the sort of data that a lot of these companies just don't track accurately.
I think the smaller groups, you have two or three. I mean, a good example is Stephen Held and what he did with Dominion and building that up with his group of investors. Escalante, same thing, where you've got the deals are syndicated because golf lends itself to being attractive for syndication. People like to be, I own the golf course, but they're only throwing in $100,000 or $200,000 and they get a return. And that's what Stephen Held did, build up this, his group of little investors and then spun it off.
Mm-hmm. When you look in the room here, you've got two different groups in here. You've got hard asset owners and you have pure management companies. And obviously private equity has backed a lot of the hard assets, but Troon obviously is just the opposite, asset light, owned by TPG. So if you've got a management company and you've got 40 or 50 golf courses, what's the opportunity out there?
Yeah, what's interesting is that historically we have seen the asset light, operators, i.e. the management companies, so the Kempers and the Troons would have certainly trade at a higher multiple, generally speaking. Yeah. I would say over time we're seeing more of a convergence, where candidly some of the asset heavy, actual golf course owners trade at or above even where sort of names like Kemper of Troon have traded. And I think the reason for that is because historically, again, there was this idea that, owning this sort of underlying asset, having CapEx, people had an allergic reaction to that, right? What they want is high free cash flow conversion. They want sort of taking your EBITDA, your profit, and, converting it dollar to dollar to cash. I think now there's a story to be told where, yes, there's CapEx. No EBITDA to free cash flow conversion will not be 100% or even 90%, but there's a huge growth opportunity here that exists with this. And so, historically, I'd say there was certainly a disparate view on value. The other thing about sort of the asset light operations out there is that, to go out and win new courses, right? Just sort of the net number to the bottom line when you win a new course, right? that sort of management fee is not nearly as great as going out and acquiring a private country club with $2 or $3 million of EBITDA. So the ability to scale, sort of the golf course management companies versus sort of a golf course ownership, business is a lot more difficult because it's just a hand-to-hand combat where Kemper wins one from Troon or vice versa, or who knows what. It's tougher to really move the EBITDA needle, if you will.
Right. We've got about 15 minutes left. Before we open up to questions, do you guys have any other comments or you want to make before we do questions?
No.
Okay, great. Let's open it up to questions. Were we that good or that boring?
Wow.
Yeah.
Either one. You were talking about the management companies, and I think every time we have an offering, we get the calls from Troon and we get the calls from Kemper, and it's always because they have an investor in tow. And that's the best way for them to, they know they can grow their business if they have an investor in tow. Well, the investor buys the golf course and plugs them in. So that's part of their growth strategy.
Yeah, and that gets back very much to what we were saying earlier around sort of, the credibility of the sort of, financing of the deal, right? If you're trying to go out and as a buyer, say, well, I don't have a private equity buyer behind me, a private equity investor behind me, take my word for it. I'll find the equity, I'll find the debt.
Yeah.
That's the last thing that we want to hear,
Yeah.
by the way. What we want to hear is that we've got a private equity firm and we've got debt financing lined up, right? And so that's a huge difference as well in terms of being able to have sort of a well-capitalized fund to be as a buyer.
That's a good point. At the end of the day, one point that I would make to folks in this room is it's not always about valuation. Never underestimate the value of speed and certainty to close a deal and what that can do for you.
Yeah,
Right.
and along those same lines, I'd finish by one more thing, is that we've heard from a lot of private equity groups is, while they're all still very much capitalists, as are many people in this room, candidly, the idea of kind of who you're working with and the sort of value of the sort of cultural and strategic alignment has become a lot more important. I think pre-COVID, it was kind of like, just find me the deal. What's the IRR? What's the return? How fast can I make money? One of the things we've heard from a lot of these different investment committees now is part of their sort of write-up is they actually ask the investment team, have you spent considerable time with the management team before? Do they like you? Do you like them? Do we have an angle in this process? What have you, right? So what we're seeing a lot now is we're getting hired a lot earlier on before a business is looking to sell themselves, to begin to have us introduce them to private equity groups and different buyers to begin to assess that and build a rapport. Because if you're just kind of coming out there cold and just dropping a book on people's desk, people will not take a look at it.
Yes, sir.
So we heard that golf used to be a bad name. Now it's the golden child. What's the threat? What bursts the bubble?
Yeah, I'll go first. I think the good thing is enough time has lapsed between sort of the COVID time period and now, so we're seeing what I believe is sort of a new normal, right? The biggest issue that we faced just across my practice in general, travel and leisure, is there was a sort of revenge travel. And, next year's going to be a slowdown. We're going to see it undoubtedly happening. I will tell you, across all the companies I cover, whether it's luxury tour operators or cruise businesses or hotel software companies, 2023 has undoubtedly been a record year for them. 2024 will be a record year for them as well. And so I think the good thing is that the idea that this is sort of like revenge travel, or that golf is just making this big resurgence, but it's going to come back down to earth at some point, I think we're past that. I think the biggest issue that will face a lot of these sort of businesses is that as they sort of trade hands, as they get larger and larger, I think it comes back to exit. I think at some point in time, the buyer pool becomes so limited that the only way to really exit is either through a really high net worth individual who can come up with hundreds of millions of dollars to buy a business, or you go public. The problem is that once you get to a certain size, there's only so many Apollos and Blackstones out there who can write a $500 million equity check or more.
I was going to say, I think that the threat really that I see is access to golf. These that younger group that's growing, that NGF showed where the growth is. My son being one of them, he can't afford $150 round of golf at a daily fee golf course. And we've been tearing out golf courses for so many years, and now we've got this supply demand issue going on. And I think when people get frustrated, they can't get a tee time, they can't get on their private country club because they're impacted. And we're seeing more and more country clubs that are maxed out on membership.
Could you guys just quickly comment on what you're seeing with respect to international buyers, trend line on international money flowing into some of these U.S. assets?
Yeah, it's funny. One of the Dave, one of the slides I had or stats I had, I didn't talk about it, was inbound international capital just in general in commercial real estate. That is down 40% as well, you know, from Q1 of last year to Q1 this year. So the inbound money is not coming in as strong as it was. The Koreans are still fascinated with golf, and when we have a it used to be just Southern California. The closer to K-Town, the better. It's now grown to Northern California. I think everything we take in Northern California, the Koreans want to buy that too, and it's gone to Vegas and Hawaii. We took a property market last year called Makaha Valley. It was 2 golf courses. One was shut down. It was residential and everything, and trying to get the Koreans to really look at Hawaii was a challenge. But by the end of the process, we'd contacted all these Korean law firms and their clients and everything. We had 4 or 5 Korean firms wanting to be in Hawaii, and I get calls daily from Koreans wanting to be in Hawaii.
You know, we work a lot with Koreans, and we find they're being a lot more sophisticated than maybe the Japanese buyers were, you know, at the turn of the century. So, you know, they are looking for a return, particularly if it's a higher priced asset. You know, if it's a country club that they can buy for $10 million or $15 million, that's a rounding error and it's a vanity buy. But if you're asking them to pay $50, $60, $70 million for something for, you know, some of the stuff you were marketing, they're going to go, I want to get a real return on it.
Yeah, the one area in addition to Asia is also sort of the Middle Eastern sort of sovereign wealth funds that we see as well. You know, for them, a lot of capital there, obviously, as we know, they have been involved in golf with LIV, what have you. But, you know, certainly there's an element there where they're looking to sort of buy into sort of experientially, you know, focused businesses in the U.S. more and more.
Well, the LIV group was always hanging around the hoop on the Pac Life transaction. They loved Greyhawk. They were finding that the best way to have an event in a major market is to own the facility.
Any other questions? All right, hey guys, thank you. I think it was very informative. You guys did a great job, and so we're gonna finish a few minutes early. So thank you very much.
Great.
Yeah.
Thanks, Jim.
Yeah, that was fascinating. Thank you so much for your time.